How do open market operations work in finance? Have you ever wondered how central banks manage the flow of money in an economy? One of the key tools they use is called open market operations. Open market operations involve the buying and selling of government securities by a central bank, like the Federal Reserve in the United States. This process plays a vital role in shaping monetary policy and influencing economic conditions. When a central bank decides to buy government securities, it pays for these purchases by adding reserves to the banking system. This action increases the amount of money that banks have available to lend. As a result, the money supply expands, and short-term interest rates tend to decrease. Lower interest rates make borrowing cheaper for consumers and businesses, encouraging spending and investment. On the flip side, when the central bank sells government securities, it takes money out of circulation. Banks pay for these securities, which reduces their reserves. This contraction in the money supply can lead to higher short-term interest rates. Higher rates can discourage borrowing and spending, helping to cool down an economy that might be growing too quickly. Historically, open market operations became a central part of monetary policy in the United States during the 1920s. Initially, regional banks conducted these operations independently. However, competition among them led to the establishment of a centralized committee under the Federal Reserve Bank of New York. This committee was created to coordinate open market transactions more effectively. Over time, especially after the Great Depression, control over open market operations shifted to the Federal Open Market Committee. This committee now directs these operations to influence economic conditions more precisely. The goal is often to manage short-term interest rates, which directly impact borrowing costs and, in turn, economic growth and inflation. In recent years, particularly following the financial crisis of 2008, central banks have expanded their approach. They have introduced programs like quantitative easing, which involve large-scale purchases of longer-term and riskier securities. This strategy aims to provide additional economic stimulus when short-term interest rates are already near zero. Open market operations are conducted through auctions, involving transactions with commercial banks and other financial institutions. This method allows central banks to adjust liquidity in the financial system quickly. By influencing credit conditions, they can help maintain overall economic stability. From a historical perspective, open market operations representing a shift in how central banks manage economies. They mark a move away from earlier tools, like discount window lending, toward a more market-based approach. This evolution has significantly shaped modern monetary policy and economic outcomes over the past century. Understanding how open market operations work can give you a clearer picture of the financial mechanisms that influence our daily lives.